Hello everyone. Today we're going to discuss about another aspect of personal finance, and this is investment. So for this week we'll be delving into the basics of investment. For the knowledge for the learning objective, we're going to set goals and be ready to invest. We're going to learn how to set goals and be ready to invest. Thereafter, we'll discuss about managing risk in your investment, allocating your your assets in the manner that is best for you, and thereafter, we'll try to understand how difficult it is to beat the market. We'll further try to identify and describe the primary and secondary security markets before delving into trade securities using a broker. And lastly, for today, we'll try to locate and use several different sources of investment information to trade securities. Now going to the introductory aspect of investment basics. Investment should be to protect and make money. We all know that for some weeks now we've been discussing about insurance and so on, buying properties, insuring your properties and so on. All these aspects have to do with spending money, all right? They have to do with spending money. But when it comes to investing, you are trying to protect your future. You are trying to get something on ground that you will be able to fall back on in the future. So investment goals should be to protect yourself and as well make money. In doing this, it is important to understand that investing from a common sense, it's important for you to understand investments from a common sense and perspective, because it's not just about putting your money into any kind of asset and you feel that automatically you are going to get some profit or realize some money at the end of the day. So you need some basic understanding of investment. A solid grounding in investing will also help you to reach your financial goals and avoid pitfall. And this still buttress the fact that you need to search, you need to look for information, you need to make your research before deciding on what kind of investment to embark upon. So before you invest, you need to know what your goals are. There are different investments, so you need to know what are your own goals before you look for investment opportunities that are going to satisfy your goals. You should know how much you can set aside to meet those goals. You know your income, you know maybe your spending pattern, and you know how much you can really set aside for the investment. So you must also know how much that you will be able to set aside if you have a particular target or goal that you want to meet. Then you should also know the difference between investing and speculating. Investing is not a short-term something. You have to like leave your money for a while, otherwise you might end up maybe trying to speculate. All right, investment is more of a long-term than speculating. So like I mentioned earlier, for investment, you need to get an asset, all right? You invest in an asset and at the end of the day, it's going to generate some return, not day as in 24 hours. I mean at the end of a particular period, all right? While speculation is just an asset whose value depends solely on the demand and supply, all right? On how much is being demanded for and how much supply is available. So all this should be put in mind before you decide on what you want to invest or the kind of asset you want to invest in. We also have the income return, which is usually in the form of dividend or interest payment. You need to also have a knowledge about what you are expecting at the end of the day as your return. There are also derivative securities, which are value derived from value of other assets. There are some assets that you derive value from them as a result of the other asset, while your option is the right of owner to buy or sell an asset. So all these are terminologies that you should familiarize yourself with if you want to become an investor or before you invest in any asset. Now, setting your investment goals. We've talked about setting your investment goals before you even embark upon them. So how do you go about setting your goals? The first step is for you to write down your goals and prioritize them. What do you want to achieve at the end of the day? How soon do you want the returns? what kind of assets do you want to invest in? There are various kind of investment opportunities that you can. So you have to explore, you have to make research, you have to seek information for you to be able to know, and then know your own goals too. Then you attach cost to them. Each will also have its own cost. All right, so nothing comes for free. Well, if you think you can cope with the cost and you want to go ahead, then good for you. So that's another way, that's another step in setting your investment goal. Then you figure out the money for those goals. The money that will be needed for the goals that you have set, because it's not just about reading and writing or whatever. You are going to invest with your money, so you need to find out how much it's going to cost you for that. And then at the end of the day, you have to periodically reevaluate your goals. Where are you coming from? Where are you particularly at the moment, and where are you hoping to be? You understand, in terms of your goal. So you have to periodically reevaluate your goal, assess your goals. Are you achieving them actually? Are you in line with what you have set to achieve? Are you trying to achieve them? So all these are ways in which, or steps in which you can adopt to set your investment goals. So also you have to formalize your goals. In formalizing your goals, you have to define them in terms of the period. All right, we have the short-term goals, we have the intermediate-term goals, as well as the long-term goals. Short-term goals are usually within a year. You want to achieve, okay, at the end of this year, I want to achieve so and so. All right, now if it's intermediate term, then maybe the goals will be formalized between 1 to 10 years, while long-term goals are those that are over 10 years. You should now note that your goals should also be realistic. You should be realistic. Don't overdo, don't overstate your goals. All right, don't overstretch yourself. You know your worth, you know your value, you know how much you earn, you know how much you can afford to set aside for investment and all sorts. So all these are determinants of how you're going to set the goals that you want to set to achieve. Your goals should be realistic. All right, otherwise there will be consequences if they are not accomplished. You should also be able to make financial sacrifices. Like I mentioned earlier, that you know your financial capability in terms of your income. So if at all you are so much motivated or so much interested in investing in a particular asset, and you feel it is worth it, then you should be ready to make financial sacrifices, maybe in terms of reducing or cutting your cost on some other spending, so that you have enough money to invest in those kind of assets. You need to determine how much money is needed for the investment, and when do you actually need the money. So if you need the money maybe in like 3 or 6 months time, then you should know how to spread it over your income, all right, so that you contribute, or you get those money over that particular period, and then you can now go for your investment. Financial reality check. Before putting your investment program in place, it's important to have a grip of your own financial affairs. All right, having a grip of your own financial affairs has to do with a number of things. First is that you should have a grip of your financial. Make sure you are living within your means. After having a grip of your financial affairs, all right, make sure you are living within your means. Don't overdo. Don't spend more than you are earning. If you are spending more than you are earning, then you are not living within your means, and it's not going to be realistic for you to embark upon any financial investment opportunities. You should also have adequate insurance for whatever asset or property you have. We've talked about that so much. Not only asset or property, even your own self, medical insurance, life insurance, and so on. So all this should be adequate enough. Then you should also set aside some emergency fund. Always keep emergency fund in case there is any eventuality. All right, we do not pray for any unforeseen bad events, but we should always keep emergency fund. That is another part of a financial reality check. So in essence, you should put your financial house in order. before you consider investing. Don't say because you are desperate to invest or because you are expecting so much returns at the end of the day, then you pack all your money and use them for investment. What if you need money for emergency cases now? What if you need money to meet up with some other financial needs? So you have to be realistic when setting your financial goals as well. So that's just the summary of everything. Putting your financial house in order before you consider investing. That is the reality check. That's the financial reality check. Starting your investment program. Before you start your investment programs, there are some things that you should know. The first is that you should pay yourself first, regardless of the situation. Anything you have to pay yourself first, because you are also considered as part of the you are the middle, you are the center of everything. So you pay yourself first before any other thing. Then make investing automatic. You should make it some kind of automatic. Maybe you want to give a bank a standing order to maybe pay so amount to your investment company at the end of each month or something like that. So you make it automatic such that the money would have been deducted before you even have your own, before the net value is now paid to your account for spending or for some other financial needs that you want to use them for. Then taking advantage of Uncle Sam and your employers. If your employer offers matching investments, don't pass them by. Make use of your opportunity. Make use of every opportunity that comes your way. All right. Matching investments are about as close as something for nothing as you will ever get. So when investment opportunity comes, especially maybe from your employer, do not let them slide. Then always make use of the opportunity of windfalls. Windfalls are, when you have this kind of unexpected, so to put an unquote, unexpected kind of money. Maybe let's call it a kind of boom. For example, maybe salary bonuses, maybe tax refund. These are not they are not part of your major income. All right, they are not part of your usual income. You have worked your lifestyle to be in conformity with your income. So when this money come, they are more or less like windfalls. So you've got to make use of them very well. It could even be inheritance. It could be gifts. It could be bonuses. It could be anything, maybe salary bonus, increment, whatever. You should try as much as possible to to invest them. Then you should make 2 months a year investment months. Fitting taxes into investing. When we compare investment returns, we want to make a comparison in an after-tax basis. You want to make it on an after-tax basis. Otherwise, you might be calculating wrongly. All right, because as we examine the different alternatives, we'll look more closely at taxes. And there are different points to hold regardless of what we are investing in. So your after tax should be your focus. Otherwise, you will be over estimating, because you still need to take your tax into consideration. The marginal tax rate is the rate you pay on the next dollar of the earnings. You are earning, you pay. So the next additional dollar, the next additional earning, the amount you pay on it as tax is your marginal tax rate. We also have tax-free investment alternatives, which you may also explore if you want to, if you are interested in such. Investments are on a tax-deferred basis. Those ones too are available. That they defer some taxes for you. With taxes, capital gains and dividend income are better than the ordinary income. Your investment choices. There are different choices when it comes to investment. You have learning investment as well as the ownership investment. Learning investments relate to savings accounts and bonds, which are debt instruments issued by corporations and governments. All right. For the lending investment, they are bonds or savings accounts or debt instruments. They are issued by especially corporations and governments. So you are buying buying them makes you an owner of that, a shareholder in that particular asset, or at the end of the day you'll be compensated by the time the bonds are, these are debt instruments that will be issued to you, and at the end of the day the money will be paid to you. All right, for ownership investment, there are preferred stocks and common stocks, which represent ownership in a corporation along with income producing real estate. So it's the ownership investment that makes you an ownership in a corporation, not the lending. For the lending, you'll be issued a document, all right, or debt instrument, so to say. You'll be issued a debt instrument, and at the end of the period, the money will be paid back to you. But for ownership investment, you become an ownership, all right, in that corporation. Lending investment includes knowing about the maturity date, the par value of the principal, the coupon interest rate, know ahead of time what the return will be, as well as going bankrupt and how you can lose the entire investment. So when you are lending, when you are opting for lending investments, you should know about all these terminologies that have been mentioned. For ownership investment, you can invest in real estate, which could be your home, rental apartment, investment in income producing property, and so on. For the illiquid one, those are the ones that are hard to sell off. It will be difficult to sell them off immediately. So you should know the kind of ownership investments you also want to invest in. Most of them are illiquid in nature. They are not easily sellable, right? Then we have the stock, which are fractional ownership in the corporation. The stock makes you have a partial ownership of the corporation, or maybe the owner or equity holder is the person who owns the stock. If you are buying equity or maybe shares, then you become a shareholder or equity holder. While the dividend is a payment by the corporation to its shareholders. By the time you buy the shares and you become a shareholder, at the end of the day, or maybe financial year, you'll be paid return in terms of dividend. So for ownership investment, you'll be paid dividend at the end of the year. What are the returns from investing? When you are investing, of course, everyone is expecting to make money, to gain. So when you are gaining, that is referred to as a capital gain. On the other hand, if it's a loss, then it's referred to as capital loss. So capital gain or loss is the gain or loss on the sale of a capital asset. By the time you sell the asset, what do you gain? Of course, if the price or the amount you are selling it is more than the amount you bought it, then you are gaining. But if it's the other way around, then definitely it's a capital loss. We also have the income return, which is any payment you receive directly from the company or organization in which you've invested. So here are the formula for calculating returns, the rate of return as well as the average annual rate of return. So for the rate of return, you calculate it by subtracting the beginning value from the ending value before you now add it to your income return and divide this value by the beginning value. So for the average annual rate of return now, it's still the same formula, just as we're going to multiply it by 1 over n. So that's how to calculate the returns. So we're going to look at risk-return trade-off now. Risk return. You know that for every risk, there is a return. Risk is related to potential return, because the more risk you can assume, then the greater the potential for your reward. Most times we commonly say that the higher the risk, the higher the return. So if you can assume higher risk, if you can take more risk, then there's a possibility that you'll be getting more in return. But also there is a greater possibility that you may lose your money as well, and that is why the risk is high. So you must take that into consideration before deciding. You have to look at the risk and return trade-off. Look at it very well before taking your decision. Excuse me. So you must eliminate risk without affecting potential return. As an investor, you should try as much as possible to eliminate risk without affecting your potential return, and balance the amount of risk with amount of return needed. There are times that the return might not actually worth the risk, so to say, so it may not worth really taking the risk. So you have to look at the trade-off between the risk and return before deciding to go on with such kind of investment. So here is a typical graph showing the relationship between risk and return. You see that it's a positive relationship, indicating that as the risk becomes higher, the return also becomes higher. This is the average annual return here in percentage, while the risk of variability of return is on the x-axis here. So this graph indicates a positive relationship between the two, which implies that as the risk goes higher, so also the return increases. Now moving to nominal and real rate of returns. We've been talking about return on your investment. So this can be in two forms. We have the nominal rate of return, the nominal or the quoted rate of return, which is the rate of return earned on an investment without any adjustment for inflation. You've not adjusted for inflation. And the second one is the real rate of return, which is the nominal rate of return after you've taken out inflation. So it's usually better to take care of inflation, so that you can have the real rate of return. It's until you take care of the inflation before you can know the actual or the real rate of return. Otherwise, we'll just be talking about the nominal or the quoted. For this one, you don't take into consideration any adjustments for inflation. Historical level of risk and return bear a strong resemblance to the risk-return trade-off graph. Like I mentioned earlier, that like we even saw in the previous graph, that there is a kind of positive relationship where you have higher risk leading to higher return. So historically, there has been positive relationship between risk and the return. Investments with higher levels of risk produce higher return. So if you look at investment assets generally, those that will generate more returns are those that have higher risk. It could be in terms of investment, it could be in terms of maybe the requirements, it could be in terms of any other factors. So all this contributes to higher risk, but at the end of the day, the return is also higher compared to investments with lower risk. So here is the risk-return relationship. Like we've seen earlier, this is almost the same, a positive relationship between average annual return and the risk or variability return. Sources of risk in the risk-return trade-off. What are the sources of risk? What are those factors that can contribute to risk in the risk-return trade-off? We have quite a number of them. We have the interest rate risk. This relates to changes in interest rates. All right, there are times that interest rate will just increase from a certain percentage to another. So, and it's going to affect the investment or the return on the investment. So that is one aspect. The inflation risk is those one that are related to rising prices, all right, and this will eventually eat away the purchasing power of money. The higher the inflation, then the lower the value of the money. What it can purchase will be lower. So that's another risk that is related to investment. Then we have the business risk as well. This deals with fluctuations in investment value as a result of good or bad management decisions. At times, management make decisions or take decisions that affect the corporations or the value of the investment. Or at times, it could be maybe how well or how poorly they are performing, how well or how poorly the corporation is performing. So these are related to business risk. Apart from that, we have the financial risk. This deals with the use of debt by the firm. How are the firm, how are they worthy in terms of maybe debt and their management and so on. So all these are related to financial risks. Apart from the aforementioned, we also have liquidity risk in addition to what we've talked about. This deals with the inability to liquidate a security quickly, all right, at a fair market price. It happens at times, sometimes it's impossible to find the buyer at a fair market price. So you end up selling them at a lesser price than the worth of the assets. So especially maybe when you are desperate for liquidity, you are desperate for money, you want to sell them on time. So if the asset is such that it cannot be easily sellable or liquefied, so it's going to be a challenge. You'll end up selling them at a lesser price than the fair price. Then we also have the market risk, all right? These are associated with the overall market movements. For example, maybe demand and supply forces and so on and so forth. Then political and regulatory risk are those associated with maybe unanticipated changes in tax or maybe government policy, the legal environment, anything. At times government may just impose a law or a rule and things like that. So all these are related to political or regulatory risk. In addition to that, we have the exchange rate risk, all right, which relates to fluctuations in the exchange rate, especially in relation to the dollars. And lastly, we have the call risk. This refers to maybe redeeming the bond early. At times, most bonds are callable. When the bonds are called, then the bondholder generally receives the face value of the bond, and then you receive the face value of the bond and maybe 1 year interest payment. So all these are the kinds of risks that you should bear in mind before you invest in any kind of assets. Moving ahead, we want to talk about diversification. You all know that diversification is has to do with maybe trying to combine a number of things rather than just one. So diversification in investments refers to a situation where you eliminate risk by investing in different assets rather than pulling all your risk together in one type of asset. So you will spread them, all right? You get different investments rather than one. So it allows extreme good and bad returns to cancel each other out. At least if A doesn't work out, B should work out. If A and B doesn't work out, C and D should likely work out. So that is just the implication. The good and bad returns are going to cancel each other at the end of the day, rather than putting all your eggs in one basket. Then there's reduced risks without affected expected return. By the time you diversify, the risk will be reduced and it may not eventually affect your expected return. So how do you diversify away your risk? Now, one of such is getting a portfolio. That's a group of investment held by an individual. You get a portfolio is going to comprise of different kind of investments, groups of investments, not just one asset. So that's a portfolio. Then we have the systematic or market-related or non-diversifiable risk. These are portions of security risk or variability that cannot be eliminated through diversification. Even when you diversify, they are still going to happen. All right, they are still systematic or market-related. Or at times, not even that they are not even diversifiable. So when they tend to occur without they tend to be out of control, beyond one's control. Then we also have the unsystematic or firm-specific or company unique risk or diversifiable risk. So all these are names and terminologies for the same kind. These are risk or variability that can be eliminated with diversification. So you should have it in mind that whether or not you want to diversify, there are still some that are, some risks are still not diversifiable, while some are diversifiable. So here is the reduction of risk as the number of stocks in the portfolio increases. You realize that from this point up to here, this is we have an horizontal curve here, meaning that it's constant all through regardless of the variability in returns. The number of stocks in portfolio is constant at this level, and then it's only from here upwards that the variability starts to change. This is the unsystematic or diversifiable risk. This here is the systematic. This from here to here we have the systematic, while this green portion relates to the unsystematic or the diversifiable risk. So the total risk comprises all what we have here. Understanding your tolerance and capacity for risk. How do you understand your own tolerance? You can understand your own tolerance by taking any of the risk tolerance risk that are available. There are websites where you can explore just for you to be able to identify your own tolerance risk. And there is need to recognize your tolerance risk and invest accordingly. You have to follow that. Your investment, your tolerance risk is very important before you embark upon any investment. Risk capacity refers to your ability to take the risk. You don't have the same capacity as human beings. So by the time you take the risk, then you'll be able to know your own level of risk tolerance before embarking upon any kind of investment. An example has been given here. All right, for one of the risk tolerance test. If you are interested, you may just visit this site. Then moving on to the time dimension of investing and asset allocation. As the length of the investment horizon increases, we can afford to invest in riskier assets due to many factors, for example, experience and so on. Or you may even have more financial capability to invest. So if the investment horizon is longer, it will probably end up with a lot more if you invest in some risky assets. How do you meet your investment goals and the time dimension of risk? Meeting your investment goals. With any long-term investment, there will be bad years and good years. Of course, with long-term investment, don't forget that we mentioned that it spans up to 10 years, and we cannot expect that within these 10 years it's only good times that will always happen, So there's always going to be good time, there's always going to be bad time. So with time, the dispersion of variability of returns in these years converges towards the average. So at the end of the day, the good time will be added to the bad times and the average will be attained. So what kind of assets should you invest in? You should try to know or identify the kind of assets that you want to invest in, especially given the fact that they are long-term investments. Investment in bonds will give less uncertainty over time, but will give smaller ultimate value than investing in riskier assets like stocks. So like we mentioned earlier that the higher the risk, the higher the rate of return. So if you invest in bonds, right, it may give less uncertainty, and it's going to get a smaller value. It's sure that you're going to get your money back, but the returns might not just be high. But there are some other ones, such as stocks, that may have higher return, but the risks of the risk associated are also quite high. So this graph shows reduction of risk over time between 1950 and 2013. Asset allocation. How your money should be divided among your stocks, your bonds, and other investments is what is known as asset allocation. How do you allocate your money among all these investments? Investment diversified in different classes of investment, like we mentioned earlier, those with higher risk, those with lower risk. You want to base them on maybe the term, all right, or the duration, the short term, the immediate, the intermediate, as well as the long term. All these are related to asset allocation. Common stocks are more appropriate for long-term horizon. Asset allocation is the most important investing task. That is not a one-time decision. It's not that once you decide on a particular asset allocation, then that's it for you. Have to review again. You have to, check all the time. It's the most important investing task that one has to do all the time. So these are factors that can impact your asset allocation. The time horizon. The more time until you need the money, the more risk you can afford to take. If you don't need the money immediately, you can leave it for a longer period of time. So if you leave it for a longer period of time, then you'll be expecting something higher in terms of return. So also the capacity for risk in financial situation. How much risk can you take? All right, so there are there are a number of questions to be answered for you to be able to determine how much risk that you can take. Then you also have the risk tolerance. Different people have different tolerance risk level, and that is why it is necessary to take some risk tests, all right, for you to be able to identify your risk tolerance. These are the different asset allocation portfolios with average returns. Then what you should know about efficient markets. When we say efficient market, this is actually a market in which information about the stock is reflected in the stock price. So the degree to which the market prices reflect all the relevant information available is known as market efficiency. If the markets are efficient, then all information is already incorporated into the prices. All the information necessary will have already been taken care of in terms of the price. They'll be reflected in the price. The more efficient the market, then the faster the prices react to new information. Once there is a news about, or there is an information about something, then it immediately reflects in the price. So that is what market efficiency is. If the stock market were truly efficient, then there will be no benefit from stock analysts actually. So this is just to tell you that there may be lag, right? So, and at times you may need the service of stock analysts for them to help you determine or decide or make certain decisions. Security markets. These are markets in which securities are issued, all right? The markets in which they are issued, they are purchased by investors, and they are maybe subsequently transferred among individuals or among investors. It's a component of the wider financial market. We have the financial market, so the security market is part of the financial market, where securities can be bought and sold. So for security market, we have stocks and bonds that are issued by corporations to raise money. So you can buy your bonds there, your stocks and bonds, and you can also sell them. The security market is divided into two. That's the primary and the secondary market. For the primary market, that is the market where we have the initial public offering. Initial public offering, that is when corporations are selling their bonds or stocks for the first time, right, after the initial issue. Then when they are going public for the first time for the sales of their stock, then they go to the primary market. That is the initial public offering. So for the primary market is the market where newly issued securities are traded, like the initial public offering that I mentioned earlier. We also have the seasoned new issues. The seasoned new issue is an issue of an additional security from an established company whose securities are already traded in the secondary market. They are already in the market, but they want to add more, all right? They want to sell more securities. So that is the seasoned issue. We also have the investment banker. These are individuals who often work as part of financial institution. They work as part of the financial institution. They are primarily concerned with raising capital for corporations, governments, and other entities. That's the work of an investment banker. Under the primary market, or in the primary market, we also have an underwriter too. Underwriter is a person or company that underwrites an insurance risk. It could be a bank or other financial institutions, and what they are going to do is to pledge. They will pledge to buy all the unsold shares in an issue of a new share. So they will only pledge that, okay, if these shares are not being sold totally at the market, then the bank would get the remaining, or the financial institution will buy the remaining. And of course, the prospectus, like we all know, is a document, is a formal document required and filled with the Securities and Exchange Commission. It provides details about investment offering to the public. So all these are related to the primary market, things that you should know about the primary market. For the secondary market, these are markets where previously issued securities are traded. Don't forget that we said the primary is where the initial public offering is made, or where you have the seasoned new issues. So for the secondary market is where the previously issued ones are traded. Maybe I've already bought during the initial public offering, I've bought some stocks, and at the end of the day I want to sell them. So where I have to go is the secondary market. So there is an organized exchange, which is a physical location where stock are being traded. For example, we have the New York Stock Exchange, and for each country, I think they have their own stock exchange as well. So we have the over-the-counter market. These are transactions conducted over phone or computer. There could be the price, where the highest price someone is willing to pay for the security. So when they bid the price, the highest bidder will get the security. Then we also have maybe ask for offer price. This is the lowest price that somebody is willing to sell a security. So once you see offer price, there is no need for negotiation or bidding. That is the least, the lowest price that the person wants to offer. But when it is a bid price, then it's the highest someone is willing to pay for a security. In that case, you can still discuss or bid for the price to be reduced. Moving on to international markets. Now, international markets are basically markets, any markets that are outside of any company's home country. All right. For example, if you are producing if you have a company in the United States, for example, and you are selling your stocks at Canada, so Canada becomes an international market for that company. So international markets have been around for centuries. some foreign shares traded on exchanges in the US. Most of the foreign countries, they trade exchange in the US. So the US is an international market for such countries. We have the American Depository Receipt, which is international stock, where international stock can be traded. The ADR is a forum where the international stocks can be traded. Like I mentioned earlier, that any market that is outside of a corporation or a company's home country is the international market for that particular country, company or corporation. Regulation of security markets. Regulation of security markets are aimed at protecting investors. All right, the basic principle or the basis is for the investors to be protected so that they will all have a fair chance of making money. For example, we have the Federal Regulatory Authority of the security market, which is the Security and Exchange Commission, or SEC. And we also have the SEC regulation authorities, for example, the FINRA or the exchanges. FINRA stands for Financial Industry Regulatory Authority. So these are meant to curb insider trading and maybe market abuses most times. They are meant to protect the investors. So for some market abuses, one of the market abuses is churning, where you have excessive trading of an asset, in a client's brokerage account for the purpose of generating commissions. These are done by maybe the stockbrokers or so. So they trade excessively on their client accounts just because they want to get their own commission. So all these are being regulated by the Security and Exchange Commission, or maybe the exchanges or the FINRA. Placing an order. Before you place an order, we should put in mind some considerations. Okay, for example, we're going to discuss about how trade security examine the difference between the trading and trade mechanism. So for example, now you should know the order size. Before placing an order, you should know the size of the order. There are some that are round lots and there are some that are odd lots. You should know the difference between the two. Round lots are common stock sold in lots or group of 100 shares. The minimum you can purchase is 100 shares. Maybe 100, apart from 100 is 200, from 200, 300, and so on. So you need to know the size of the order size before you place your order. Then we have the odd lots. These are all orders involving between 1 and 99 shares of stock. You can purchase between 1 and 99. Then another thing you should consider before placing an order is the time period for which the order will remain outstanding. It could be day orders, it could be open orders, or go to cancelled orders. It could be fill or kill orders. It could be discretionary accounts. So all these are the various time periods for which the orders can remain before they are cancelled. Here are types of orders. We have the market orders, where you buy and sell immediately at the best price available. We also have the limit orders. This is where trade is to be made only after a certain price or a better one is achieved. Then we also have the stop or stop loss orders. These are orders to sell if the price drops below a specified level, or to buy if the price climbs above a specified level. So all these are the types of orders that you should know, and you communicate duly with your manager, all right, so your investment broker, on when to buy, when to sell, and so on. Short selling. The more people, the more the price drops, the more the money you make. When the price drops, that is when you make more money. So that is what is short-term selling. It involves borrowing stock from your broker and selling it. You borrow stock from your broker and then you now sell it. So if the stock prices go down, you will buy it back and return it to your broker. It doesn't necessarily have to be your own. It could be someone else's own, maybe it has not been traded or so. So what you do is when the prices are low, you buy them back after you must have sold them when the prices are high, after you must have borrowed them from your broker and sold them when the prices are high. So you make a profit by buying it back far less than you actually sold them. So you sell high and later you buy low and return it to the stock broker. Meanwhile, if the prices increases, you buy back for more than the sold price and you're going to lose money at the end of the day. So it all depends on you, your knowledge, your luck, and so many other factors and risks that are involved. So here is a figure showing profits from purchasing versus selling shorts. So profit from purchasing stock and later selling it versus the profit from selling short. So if you are just buying it and later selling it, your profit is the ending price plus the dividends, then minus the initial price minus the total commissions paid, versus when you are making profit from selling short. So it's the initial price here minus the ending price plus your dividend. Look, compared to here where you add the ending price and your dividend and then you subtract your initial price from it. Here you are going to subtract the addition of your ending price and dividend from the initial price. Dealing with brokers. How do you deal with brokers? Of course, as an individual, you are not entitled to go to the floor of the stock exchange or whatever to go and trade. You have to deal with brokers because they are the ones that are licensed or authorized to trade there. So most common way to purchase stock is through a stock broker. They are the ones that are licensed to buy or sell stocks for others. We have this full service brokers or account executive. They are paid commissions based on the sales volume. While we have the discount and online brokers, they execute trade but do not give advice. They execute whatever you ask them to do, but they don't give any investment advice. Under brokerage account, we have the asset management account, which is a comprehensive financial services package that can include a checking account, credit card, the mutual fund, loan automatic, and every all the listed kind of loans. Then we have the primary advantage, which is automation of asset management account of the brokerage account. Next is the cash versus the margin account. The main difference between the cash account and the management account is the fact that investors with cash accounts pay in full for their security purchases. All right, with the payment due within 3 business days of the transactions. While for the margin account, the investors borrow a portion of the purchase price from the broker. Investors are going to borrow from the broker when it comes to the margin account, while that of the cash account, they pay in full for their security purchases. We also have the joint accounts, which are accounts owned by more than one person. All right, we have the joint tenancy account, which is the right of survivorship, and this implies that when one owner dies, the other one receives the full ownership of the assets in the account. On the other hand, we have the tenancy in common account. In that situation, where in this situation, when the deceased portion of the account goes to the heirs of the deceased, when someone dies, then the account goes to the heir or the next of kin. So rather than putting the account under the second person, rather than the second person receiving the full ownership when you have the joint tenancy account, for the tenancy in common, it is the heir of that person that goes on with the account, not the surviving account holder. So here are the things to take note before choosing a broker. You have to, whether you want to use a full service broker, they provide personal service and advice, but their own prices are higher. You may also want to consider using a discount broker. They keep transaction costs down with less personal service, but some offer free research reports. And then, you have to make your own decision by becoming knowledgeable on your choices, whether you want to use a full service broker or a discount broker. Moving on, we are going to talk about online trading. We all know what online trading is. So just trading generally on the internet. So we have the day traders. They trade generally on the internet with a very short-term horizon, almost on a daily basis. You should be prepared to suffer severe financial losses if you are going into this. Don't confuse the day trading with investing, because like we mentioned at the beginning of the discussion, investment is more of a long-term stuff, and at the end of the day you are expecting something in return, rather than the the daily trading, which is more of speculation of maybe increase based on demand and supply. Don't believe claims of easy profit. Watch out for hot tips or expert advice. Always watch out for hot tips. Make your research or consult with experts. Here are the sources of investment information where you can consult or where you can make your research to get information about the different types of investment. Right? We have the corporate sources, which are sources from the corporations and the likes. We have the brokerage firm reports, the report from the firm, the press also, maybe some news papers, some business or financial newspapers, and so on. We also have investment advisory services and also internet sources. There are some sources on the internet too that can be consulted for investment information. So here are examples of sources of investment on the web: finance.yahoo.com, money.cnn.com, money.cnn, fold.com, and this sec.gov. So all these are sources of investment information that are available on the web. So finally, we've talked about determining your goals and how to start investing. We've discussed the fact that investing is not the same as speculation. There is difference between both of them. Risk associated with investments are a lot. We mentioned a number of them: inflation risk, business risk, financial risk, and so on, and even the core risk. So you can make more risk with a longer time horizon. We also mentioned the fact that risk can be reduced through asset allocation, and the fact that primary security market is where new securities are sold. Secondary market is where those that have been sold earlier can be bought and sold again. We mentioned the fact that usual securities are traded in the secondary markets. Then we showed, we also touched the fact that market order, limit order, and stop loss orders are used to specify your buying and selling preferences. And at the end of the day, most importantly, you have to do your research. All right, consult many sources, internet sources. There are different sources, corporation sources, the press. We mentioned quite a number of them. All right, press, corporation, and the release. We have the internet and so on, and so even the experts in terms of the brokers as well. So on this note, we've come to the end of our discussion again. Hope to see you next week when we'll be moving to another topic. Before then, do take care of yourself and stay safe. Bye. Thank you for your audience.